The president of Wealth Quarterback LLC, a registered investment advisory firm located in New Jersey. Registration is not an endorsement of the firm or its representatives by securities regulators, nor is it an indication that the advisor has attained a particular level of skill or ability. Investment advisory services may only be provided to clients in jurisdictions in which the firm and its representatives are appropriately registered or exempt from registration. You should not assume that any discussion or information contained in this broadcast serves as the receipt of or as a substitute for personalized investment advice from the advisor. Different types of investments involve varying degrees of risk, and there can be no assurance that the future performance of any specific investment, investment strategy, or product, or any non-investment related content made reference to directly or indirectly in this broadcast will be profitable, equal any corresponding indicated historical performance level or levels, be suitable for your portfolio or individual situation, or prove successful. Past performance is not indicative of future result. Investment advisory services offered through Wealth Quarterback LLC. Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Hey, welcome to the Financial Quarterback. My name's Jim. I work with Josh here, and some of the topics that we'll be discussing today in the upcoming hour is this should have been a great year for gold, and here's why it isn't. Also, we'll be talking about the extended tax deadline that is fast approaching for 19 million Americans, what to know if you will still haven't filed. Also, how are Roth 401ks distributions taxed? And some millennials and Gen Zers are closing investing accounts over inflation. Here's why that may lead to regrets. And Josh, how is everything going today?
Wonderful. Thank you, Jim. So, folks, a lot of you are wondering what's going on with the stock market roller coaster yesterday. Interesting stat a buddy just shared with me today is 33 million puts traded on Friday, the highest single day of put volume since data began to be collected. So people are scared and people are betting against the market. They're rushing to hedge. And here's the problem. That could, turn into a trade against them, but a lot of you are worried. Also, we have a number of things. Michael Gayed, CFA on Twitter says, keep saying this isn't a black swan when you never had a period in a major stock market drawdown where long duration treasuries, the risk off asset, are not only down more than stocks peak to trough, but also have this persistent a path of losses. 20-year treasury drawdowns overlaid against the S&P 500 drawdowns. So this is pretty crazy. We are living in an anomaly. And people might be thinking about the stock market is troubling. The real thing that is troubling is the bond market. So wake up, folks. Start paying attention to your money. Call us 800-321-0710. 800-321-0710. 800, you got to close that door. There's echoes. This should have been a great year for gold, but why isn't it? According to the Wall Street Journal, the outlook for gold remains vulnerable until the Fed stops hiking rates. Why? I got a call from a dear listener today. I heard I can get a 2-year treasury for 4%. Yes, you can. Call us, 888-988-JOSH. Now, you got to pay somebody to do it. So the 3 might boil down to 4, might boil down to 3, but you can get 3% for 1 year right now. That is epic. So call us right now, 800-321-0710. I'm rather bearish today. Time to hibernate. What are you thinking? I want to know, what did this week's Fed announcement do to you? Did it do anything? Is the Fed, I said this, I don't know, a month ago. We were doing the soft landing. We were elegantly crashing. And then there was a rally in the summer of 2022. But this looks to be the sell Rosh Hashanah, buy Yom Kippur trade. So, there's a thing traders say, sell Rosh Hashanah, buy Yom Kippur. And I think 3450 on the S&P may not seem too far off. So what do you do, folks? You only have in the market what you're willing to lose. I say this over and over again. Now realize, equities are still the place for long-term wealth. Over 5 years, 10 years, it's a little shaky time right now. So we have political uncertainty. We have Russia-Ukraine war. Now add to this, the Fed is trying to drive assets down. So the Fed doesn't care about you. They care about the Wizard of Oz. They say they care about employment. They say they care about labor participation rate, all these other things. They care about the belief in the Fed. So what's happening? We have red hot inflation. You know why we have red hot inflation? COVID, we gave everybody free money for a year and a half to sit at home. So what did rich people do? They said, hey, I'm going to take the cheap money. I'm going to buy up risk assets. I'm going to buy crypto. I'm going to buy stocks. I'm going to buy any type of thing imaginable. And people sat at home. So there was no incentive to work. So we have rising wages now. We have rising food costs. We spoke about the proliferation of billionaires gobbling up farmland. That then they're not using it. So if you want to stop inflation, the answer is not going to be the Fed. The Fed can only stop the inflation of assets. Does that make sense? So if they raise rates to 6-7%, what's going to happen to the stock market? It's going to fall by 30-40%. What's going to happen to the real estate market? It's going to fall from peak to trough, 30-40%. I mean, if you raise rates, then affordability goes down. So people can only afford a $350,000 house instead of a $500,000 house. So that's where we're at. Asset inflation is enemy number one for the Fed. But what say you? Give us a call, 800-321-0710. 800-321-0710. This just in. Crypto King has luxury cars seized after $35 million vanishes. Well, if you were involved in these altcoins, and they're actually used by a word that I can't even say on the radio, it rhymes with Bitcoin. However, I, for one, folks, have warned about these. Now, Bitcoin is different. I think it's here to stay. Although it is not a panacea, it's not a be-all, end-all. It's not like you're going to magically put it in and double your money overnight. Sure, that happened when you were sitting at home during COVID, but not anymore. People are coming out. And they're seeing that their Bitcoin was seized. The Crypto King has a luxury car seized after $35 million vanishes. By the way, I predict more. I predict a wave of these real estate kings. You know the guys with the Lamborghinis on social media. You ever see these guys, Jim? No. They're driving Lambos. They're showing you how wealthy they are with their $25 million pad in Miami. That guy's going to be bankrupt and living in a van down by the river. Are you prepared? But people, youngsters, no offense to our new intern, They listen to these people and they want to be ballers. And they don't realize that true wealth really doesn't do that. People that we serve that have millions saved are generally, yeah, they might have a nice, whatever, Escalade or whatever. They might have a nice Tesla. They might have a nice whatever car, but they're not balling in the Bentleys. Most of those people, what they do is they rent a $250,000 car for the video to give the allure of success. You know what? I'm going to do that. I'm going to do a financial planning ad with me in a Bentley or a Lambo, and people are going to say, wow, that guy's successful. That's what they're trying to do. And you don't realize what's happening. There's laws of influence that are just sucking your kids' money dry. So you're going to have a whole generation of kids who lost money in crypto who are going to be tuned out on investing. And they're going to say, the game is rigged, the game is rigged. No, the game in crypto is rigged. If you buy Walmart and Costco, and I own it, and we own it for our clients, but if you buy good quality businesses for decades, that's the Warren Buffett way to wealth. And folks, that's probably the way to wealth long term going forward. So we have a lot that's on the mind of listeners. Jerome Powell just warned that the U.S. housing market needs a difficult correction so that folks can afford homes again. But here's why it'll look nothing like 2008. This is from Jing Pan. It's a bit bullish. It actually gives good news, even though the headline's a bit scary. I just got off the phone with a realtor in Hawaii. Luxury real estate is cratering. I'm talking like you could get $1 million off of the house. Now, why is that? Jim's got the thumbs up. He wants to go to the Hawaii beach house. No, I didn't have much luck with my old one. But I always look.
Now's the time.
No, give it a year. Give it a little bit more. But what I'm seeing is money's drying up. So offers that were maybe $300,000 higher. Imagine paying $300,000 less if you waited a month or two. That's happening. So dramatic drops in real estate. Why? The rich can't play their games anymore. By the way, I have nothing wrong with interest rates being high. People say, oh, interest rates are high. I think it's a great thing for middle-class people to realize saving and thrift is a good thing. Saving at the bank. I long for the days of 5% CDs. Well, folks, we're coming very close to those days. I'm seeing 4.05% 3-year annuities net of fees. And I get some of you who say, well, I'm going to wait till rates are higher in a year from now. They may not be higher because the Fed is attempting to tank the economy so they can drop the rates in a year. So we may be living in a golden age if you're looking for retirement income products. So don't let this slip away. Call us at 888-988-JOSH for your no obligation review. Up next, I'll be talking more about real estate and people. It may be the worst place to put your money in right now. Give us a call, 888-988-JOSH, 888-988-JOSH for the free 27-point ultimate financial game plan. Don't touch that dial.
Tune in to the financial quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory. Or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
We're back. This is Josh Jalinski live on Clubhouse, taking your calls on all matters financial. If you have stocks, bonds, annuities, mutual funds, we're going to go to the phone lines next. And we have a wonderful listener. Go ahead, Jack. Go ahead.
Good morning, Josh. My question is if you can explain about the price of gold dropping and its relationship to inflation. You had an expert on your show during the year that did a very good explanation on how that was portending the forecast of inflation. Could you explain that? Or
wasn't he like the greatest, right? David Ranson?
Yes.
Now, can I
Yes.
explain that? That's a good question. It's funny, I emailed David Ranson last night. We got to get him on again. Definitely. Because this guy, people laughed at him. They said he was too old. You know what? I love talking to older people. They're filled with wit and wisdom. And this guy, he is a precursor. By the way, we had him in a Bitcoin room on Clubhouse, and people were trashing him and giving him disrespect. Well, he showed them he was smarter than anybody. By the way, this guy went to was an undersecretary of the Treasury. He was a part of the Chicago School with Milton Friedman. The guy was no slouch. And he looked at the forward price of the gold futures market to say that inflation was indeed persistent. And he had an article called Transitory or Sustained. He looked at the forward price. I hope this does not bore people, but he looked at the gold futures market and compared that to strips, so treasuries, and it was a ratio that he used, and I'm going to botch it, but basically he used that to predict that we were going to have persistent inflation. So we're going to have him on. So basically he looks at the strip price. His source is a fixed income market database now owned by Intercontinental Exchange. Its original creator was Merrill Lynch. We've been using it for decades. And essentially he creates this thing where it's kind of laborious, but he calculates the forward price of gold as a ratio. And if his ratio's up, inflation's persistent. So, am I losing you? But it's basically treasuries and gold, and it's a little more complicated than that. But man, David Ranson proved...
The price of gold that's shown every day on all the...
No, it's the forward price of gold. So this is from his email.
How many months in advance is that?
I calculate the forward price of gold is the ratio of the spot price of gold to the price of the 30-year principal treasury strip, which comes in the form of an index. My forward gold price figure is therefore also expressed as an index. And, I'm not going to do this anymore because we're losing people. So, folks, give us a call, 800-321-0710. But you're a great listener, Jack. But basically, it is the ratio of the spot price of gold to the price of the 30-year treasury. And he plots that like every day or every week. And if that's going up, it's a signal that inflation is persistent. If it's going down, and folks, I've had so many commentators on, he's the only one who got it right. I guess him and Larry Summers. But Larry Summers was more of a commentary on just, if you're printing all of this money, stimulus, what do you think's going to happen? So I hope that helps you. But yeah, he was way accurate. So basically, he looks at it's a ratio of the spot price of gold to the 30-year principal treasury strip. But that's enough. Any other questions on that, Jack?
No, I guess he was correct in what he said when he was on your show. I'm wondering now, where are we at for the next year to year and a half? What is it saying now going forward?
I will tell you that these indicators that are right so often are right for a while until they're not. So, yeah, we'll get him on again soon. He's a great find. No, yeah. David Ranson is his name. Website is HCWE. We had him on in May. We had him on. The reason I get respect for, I had him on like a year and a half ago when he said this. When other people were saying deflation, disinflation. I don't believe deflation is or disinflation is out of the question, just out of the question for now. So we shall see. I think the Fed wants to keep rates high to spurn. I actually think if the Fed did nothing and just kept the rates as high as they did for now, we'll see a correction in asset price inflation. We don't need to do much more, by the way. I don't think they want the illusion of it's like the Wizard of Oz. Toto, we had him. They saw that there are many people, Jeff Snyder and others, that's saying the myth of the Fed. So I personally think these guys are getting ticked. And they're saying, forget the myth of the Fed. We have to reestablish the faith in the Fed. That people weren't fearing them anymore. The problem is I thought they were sort of achieving their quasi-soft landing this summer. And then they came out of Jackson Hole and they said, Jackson Hole, Wyoming, where they vacation and they have their talk, every August, the Fed convenes in Jackson Hole. And, I was sort of bullish, not bullish, but I wasn't pessimistic until I heard the August statement, because that to me signaled we have to reassert the power of the Volcker myth. And then this Wednesday, everybody was excited. Most people were bullish. And then, boom, if you break down those comments, Powell's comments were directed against asset price inflation. And it was a signal that they will stop at nothing, essentially, to bring us into some recession. And, I'm a little concerned. I'm very concerned. To me, we look at the big five as a firm. The Dow, the New York Composite, the S&P, the Dow Transports, and the NASDAQ. So the Dow, the NASDAQ, the S&P, New York Composite, and the Dow Transports. 3 of those 5 hit new lows this week. It's pretty bearish. I will tell you, there is a silver lining. The last time it was this bearish, the readings were around October of 2020. They were all 3 breaking new lows. People were like, oh, this is the, Biden depression, because Biden was about to be elected. Then Biden was elected. Everybody thought the market was going to tank, and it ripped higher and didn't look back for, since now, basically. Where we are today has evaporated about 2 years of market history. So your money's done basically nothing if it was all in the S&P for 2 years. You'd have been better off in fixed annuities and life insurance. So, folks, give us a call, 800-321-0710. If you have a question, invite your friends to listen, 800-321-0710. The Federal Reserve raised its benchmark interest rates by 75 basis points on Wednesday, making the third such hike in a row. Higher interest rates translate to bigger mortgage payments. Not good news for the housing market, but cooling down housing prices is part of what needs to be done to bring inflation under control. I'm in New Jersey. We have people around the country listening. I want to get our listeners' take. Call us at 800-321-0710. We have listeners in Massachusetts, California, Illinois. What are you seeing with your own real estate market? Now, anecdotes don't mean much, but, like I said, New Jersey, pretty strong still. Now, I don't know if that's because New York just vomited out. No offense, New Yorkers. We have many New Yorkers listening. Jennifer, you're in New England. Are house prices still strong, or are they coming down? Go ahead. Okay, I don't hear you. Okay, we'll get back to you. Oh, go ahead. Go ahead, Jennifer.
Yeah, the housing prices are definitely starting to come down. I took a look last night at some houses that I've been following, and they're not closing quite as fast as they were before.
Sure. Well, that may be the case. I mean, I'm seeing that in like resort towns, I'm always looking at Cape May, New Jersey, beautiful Victorian beach house, for that special beach house. And I'm seeing them drop a couple $100,000 for a beachfront, $300,000 for a beachfront, for something off the way that was, maybe $1.5 million. Now they're going for $1.2 million. I don't know, though, frankly, if the house that's $500 is really going down to $400. I think they're going to $475, $450. I think affordability matters. I think for that person who needs a home, young family starting, they're probably not going to stop buying a house due to the economic factors. So, but I think it's going to affect, more fringe, particularly resort towns kind of bumped, may affect the Adirondacks, the Catskills, the Poconos. I don't know, but if you have a question or comment, in your real estate market, are you seeing, I'm seeing things slow, but not things crash. So that's a good sign of the economy. Employment is still really strong. A lot of these narratives are, it ticked up. Yeah, well, if it went from 3.6 to 3.8, it's still very low unemployment. Now, Stan Harley, who we've had on before, talked about unemployment as a thing where if it goes from 3.6 to 3.8, that's a negative sign because typically it starts to creep up as you go into a recession. So, folks, give us a call, 800-321-0710. If you have questions on stocks, bonds, mutual funds, the economy, big problem this week. For the longer term, what we need is supply and demand to be better aligned, Powell said, so that housing prices go up at a reasonable level and that people can afford houses again. Who does this guy think he is? God? I'm going to control the price of houses. This is the illusion of the Fed, but they might just get what they want. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Tune in to the financial quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jalinski to call the play. for a free copy of Josh's book, The Retirement Reality Check. Call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org.
Live on Clubhouse and WOR. You can get replays at Financial Quarterback on Spotify, iHeart. You can also check us out right now at YouTube. I'll maybe do some charting, show you some TA. Joe has a comment on Illinois real estate. Joe, go ahead. I see what you're seeing as well.
Yeah, no, it's extremely stratified. That's my comment. And it's exactly what you were alluding to a moment ago. The higher end market is slowing rapidly. Every realtor I talk to is saying, north of 750 is slowing, 750,000 is slowing extremely quickly, but the middle and lower tiers are still pretty hot.
Yeah, and that may provide sort of the end of the bear market. Maybe mom and pop, regular person will be the bottom. Still, to me, that signals if an average price in an area is 500,000, it could go to 350. If it's 400, it could go to 250. It reminds me a lot of the 06 to 08 period where houses were just so unaffordable. My wife and I were looking for our dream home. And we looked, and literally we waited from about 06 to 08 to 2010, and the price of houses was cut in half where we wanted to be. And I think that'll probably, maybe it won't be a half, maybe it'll be a third. But you got to realize, if you're north of 750, north of a certain amount of money, you can't get that very cheap mortgage anymore. And although you might be able to afford cash, you don't want to spend your cash on that. So, very good point. Folks, put your comments or questions in the chat box. I will be showing, do we have the ability to share my screen? I can share my screen. If you look at the price action, because I could share a screen for our YouTube people, one of the things you want to look at, I'll give you a bullish case and then a bearish case. Yesterday, for all the pain and the carnage, we did not break the June 17th lows. It's a good sign. Bad sign, we shattered the New York composite lows. So, very critical. If you look at the NYA, I'll bring it up. It is one of the broadest measures of stock market success. So, you want to look at the big five. Now, Stan and I go back and forth. I actually think, the Dow Transports, the New York Composite, do they really factor in as much as the S&P 500 and the NASDAQ 100? I think that so as those go, so goes the market. So I think it was bullish that the S&P and the NASDAQ did not breach new lows. But the New York Composite, the Dow Transports, and the Dow all broke through their June lows, signaling we could be headed to 3450 in about a week. And it could be another one of those sell Rosh Hashanah, buy Yom Kippur, trader averages. Hope not, because we could be starting out from way lower. But if you look at the worst it was yesterday was about 11,926. And we basically not shattered through the lows, but we breached the dam of June 17th. That to me is a very bearish signal. So we shall see, You got higher lending standards, got all these problems that will create more and more problems in the economy. Big problem. Now, right now, though, housing demand remains strong while supply is still in shortage. That is the line by financial media. I will tell you that it did not take until 2010 to 2012 for us to see the crash in real estate prices really cool down. So I'm reading a Yahoo Finance article right now, and it says, right now the demand for housing remains strong while supply is still in shortage. That dynamic could start to change as the Fed tries to curb demand by hiking interest rates. and they mentioned Dave Ramsey is an expert, acknowledging the slowing rate of increase in home prices right now, but doesn't expect a crisis like '08. It's not always as simple as supply and demand, but it almost always is. Here's where we could have a crisis like '08. A lot of people have gotten into multifamily, apartment complexes. They got into markets. So if the '06-'08 crisis was due to mom and pop buying a house double what they should have and double what they could have afforded, the McMansion craze of the 2000 and 2008 phase, this crisis may be generated from influencers on social media. I've heard so many people say, I have a multifamily investment. I have a REIT. You can buy have you heard this, Jim? I can buy, you too can buy a $10 million apartment complex in Fort Lauderdale, or something like that. And people did. And they used cheap money, interest-only mortgages. So I think if there is a crash, it's going to be in this apartment complex, multifamily space. You might say, well, what does that have to do with us? Well, if you were getting $2,500 in rents and you can't get $2,500 anymore and you can get $1,250, well, then what's going to happen is those apartment complexes are going to be foreclosed upon. I've seen like guys who are complete idiots. They've become real estate millionaires in the last 5 years. And I think that's where you might see a crash coming. So could social media be the cause of the next crash? Potentially, yes. We shall see. And by crash, you might say, we're in a crash. I think this is a normal correction. If we start seeing things go from 3,600 to 3,450 and 3,000, which could be possible into December, late November, that's when you start to get worried. But, I wouldn't fearmonger. It really isn't. Nobody knows the exact future. The future is sometimes won by the optimists, not the pessimists. But things this week did not look good. 23-year-old crypto king has luxury cars seized after $35 million of investor money vanishes. Aiden Pletersky bought ads disguised as news articles on websites like the Daily Caller to promote himself. I will tell you that I've seen this more and more. People, Amazon resellers. I got scammed this week by a Amazon reseller of refrigerators. So, a company based in Brooklyn, they buy the excess refrigerator. You can't buy it through a normal supplier. And so, I'll buy it on Amazon. I trust them. So you buy it on Amazon. And Amazon was good with it, but these websites, you got to be careful who you're dealing with. A lot of frauds out there. So give us a call, 888-988-JOSH, 888-988-JOSH. We're going to take your calls on all matters financial. If you have questions on stocks, bonds, annuities, mutual funds. Shelley, you have a comment on your apartment building. I don't know if you mind sharing what state you live in.
Oh, yes, I live in Vegas.
Great. And
Nevada is the state.
And you said your apartment building sold 3 times? Talk about it.
Oh, yeah, I find it interesting. One of my best friends does commercial real estate, a lot of different lanes of it. And so I pay attention to things beyond just being a tenant. And I always find it interesting when they sell the property. And that's what I'm waiting to see, because they just painted the building for the first time, which I want to believe is just because they want it to be beautiful. But I have a feeling they might be getting ready to sell again.
Yeah, that makes perfect sense. But yeah, apartment complexes were big because you could use cheap money, finance the debt, get massive write-offs. And it's funny, I sometimes see these influencers just say, oh, just take out debt. Well, yes, debt can be a write-off if used for business purposes. The wise use of debt is very good, but debt could also make you dead financially if you're in a 2000 to 2002 style crash or an 06 to 08 crash. Google just said, hey, we're tightening the waist belt. So, yeah, interesting point. Amazon scammers. Pastor Josh, we'll get your comment on Amazon scammers not lasting long. That is true. I mean, Amazon held it well. They did refund something, but it was a big scam. So, folks, give us a call, 800-321-0710. We'll take your calls after the break, 888-988-JOSH, if you want the 27 ultimate financial game plan, 27-point checklist on what to do with your money in these uncertain times. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check. Tune in to the Financial Quarterback Josh Jalinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jalinski.org. That's JALINSKI.org.
Okay, we're back. This is Josh Jalinski, the financial quarterback, and we're going to go to John and then Tina. Go ahead, John. John, you there?
Hey, sorry,
John from
put the phone down for a second,
Go ahead.
Josh, before the commercial. So just a quick take on the real estate thing. So I think as like prices go up, especially the price of mortgages, right? We're like looking at like 7%. I think it's going to force some people that probably would have been in the buyer's market into the renter's market. So I don't know if I necessarily agree with like the take on the rental properties. I mean, I think there's some other factors like government and intervention and remember during COVID they had an eviction moratorium, and there was some really, I think, heavy-handed things for landlords. But effectively, like, I think this might push rents up even further. Ceteris paribus kind of supply coming online, or any other movements in the housing market. So I mean, I can see a kind of sort of narrative where just buyers are forced into renting, and that propping up the rental market a little bit further. So
yeah, that makes sense. I mean, that's fair. We've had a lot of we had two demographers, not Harry Dent, but two leading demographers nationally on over the summer. I don't know if you heard them, and they all said the same thing. So they said, there's so few houses for so many people that there may be a cooling, but not the type of woe that 08 saw. But I'm just saying, in certain stratified sessions, I mean, I still think if, a house is selling for $500, I could see it selling for $350, which would be a pretty significant drop. But yeah, no, and the multifamily makes sense. I'm just seeing, I've just seen too many people who are like idiots the last 5 years get sick amounts of money from investors into these projects like Shelley was talking about. And I don't think it's going to be initially. I think it might be 2 to 5 years out before they can't service that debt. So I'm saying it might be a future thing, not really like this year. It's not going to be a cause of like an '08 crisis. But good point.
Yeah, I don't dismiss that either. I just think that like there could be a different kind of story that plays out, just weighing that into the conversation.
Yeah, no. I think it could be demographics could cause that market to be bolstered. I just know, I mean, I'm sure you've heard these people, and, there's so many REITs out there. There's so many, companies like Blackstone and others. I mean, they're probably doing it the right, they're probably smarter. They were probably sellers, months ago. But a lot of regular, I would say mom and pop people, successful entrepreneurs, hey, I need some write-offs. I'm going to go buy some real estate. And then they're stuck with no rents or reduced rents because they were planning on 2,500 rent rolls forever. But yeah, I could see that. Okay, next up, Tina, you're on. Go ahead.
Hey, Josh. I had an interesting comment in Spaces yesterday. We've been in a bull market for so long. This person was saying, and he's done some work on this, it didn't cite statistics, but there's a lot more borrowing in stock accounts for high net worth people to use to fund their lives. And he mentioned what most people don't often think about is they don't think about the impact of the bond market on the equity in a portfolio. So people have been hit twice. They've been hit in equities, plus they've been hit in the bond portion of their portfolio. So this could put a lot of downward pressure as prices go lower. And we've seen it in both the fixed income markets as well as the equity markets. So I think that this could be an area that could be a problem.
Yeah, the 30-year Treasury blown up. Nobody wants it. I will tell you that may be due to institutions and insurance companies saying, hey, we got screwed. We couldn't get interest rates this long for a while. A lot of institutions will buy 10 and 30s and things like that. Guys like Scott Minerd, who you see on TV, kind of made their money buying bonds for insurance companies. Those guys are really sharp, and they may be just saying, hey, we're not buying what the Treasury's selling.
Josh, that's not what I'm saying. What I'm saying is that people have borrowed against their portfolios in order to finance their lives. And so what has happened is there has been more of a hit to the equity in the portfolios, and it's been a hit on both the equity and the bond side. So when you have debt in a portfolio and the equity has been hit, you leave the portfolio more subject to margin calls. That's what I'm saying.
Oh, totally.
And so there is more risk in the system because you haven't historically gotten such a destruction of equity because you're having it happen in both the fixed income area as well as the equity area. That was my point.
Yeah, and I think particularly in bonds, because the typical 60-40 portfolio that the average financial advisor espouses to clients, that 40%, not us at the Financial Quarterback, the 40% that they own is in bond funds. And the bond funds have lost a lot of money. And the capital destruction is significant for somebody who's supposed to be moderate. They might be down 20-ish plus 25%, and they thought they were moderate. And they don't realize that maybe it is moderate relative to equity risk, but they didn't have 40% in cash. They didn't have 40% in actual treasuries. They had it in bond funds and ETFs, which are cratering. Maybe good deals long term, but right now it's really scary. Wall Street Journal did an analysis on the typical moderate portfolio, and this was before this little meltdown we had this week, down about 20%. So if you're moderate, you're down about 20%. That's about average right now. Not that brings anyone solace, but it may get worse as rates increase. So, folks, we'll take our final break of the hour. If you have a question, give us a call, 800-321-0710. Type your question in the chat or raise your hand if you want to come up on Clubhouse. Folks, give us a call, 800-321-0710 if you want to get live on New York Radio right now. 800-321-0710. This is Josh Jalinski, the Financial Quarterback, Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, we're back. Next up, Gordon, you're on.
Yes, Josh. Good morning. I'd like to know if we, if as of now, any interest rate on a treasury has gone above 4%, and if it is, and secondarily, is it possible that we could have a 5% or higher rate on a treasury of below 10 years in the foreseeable future?
Sure. Yeah, it's very foreseeable in the foreseeable future. I think that's the problem the Fed is trying to tank asset inflation with. So we have some deep problems with treasuries over 4%. Yeah, I mean, it definitely could happen. Although, personally, if you have the emerging markets crater, if you have the worldwide stock market collapse, they're going to look to flight, kind of the flight to quality. So just from Bloomberg a day ago, Japan has a pile of dollars it can tap before selling treasuries, but that could be a problem. Interest rates are topping 4%. And a lot of you still aren't taking advantage of, the best 1-2 year treasury rates we've seen in years. I guess you think it's going to be higher. I think in a year from now, it could be higher, could be significantly lower if we have a recession. I mean, if we have, an S&P at 3,000 and a 20 to 30% correction in real estate, even though to me that would be very natural correction, people don't view it. We don't like pain. I mean, frankly, I think it's a sign of economic strength that rates are so high and we're at 3650-ish on the S&P and not 3,000. There are still strong signals in the economy. But, I mean, the economy is also sick, too. So it's sick on the macro level. But, I mean, like, individual households think are strong. People aren't losing their jobs yet. Yet is the operative word. But we shall see. I think trying to predict where treasuries go is, I mean, a year ago, many people said, hey, they're going to be, we're going to have deflation, disinflationary characteristics for as long as I could see. We'll have low interest rates. I think you have to build a portfolio that is anti-fragile, that is resistant to talking heads. I always tell people you want to have some money on inflation, some money on deflation. And if you had your portfolio 50% inflationary, 50% deflationary, you do better than most in these types of uncertain times. Mm-hmm. And the traditional 60-40 portfolio, which I've been talking about since my book came out, Retirement Reality Check, still on Amazon, and you can go to get it at retirementrealitycheck.com. I talked about that for 3-4 years, before all of this, because I just saw that the average financial advisor does very little except blindly put you into certain indexes. And I thought the next meltdown would be index fund related. It is, but not like one would know. I think it's due to probably index bond funds if we see a bigger correction. So folks, give us a call, 800-321-0710. From YouTube, says we need to redefine the idea of landlords and property owners it needs some type of regulation at this point. Not really, but how and where is the question? A world of 9 billion with 1% having the wealth. Sound like Bernie Sanders. Okay, folks, give us a call. We got to take our break. We will be back for the next hour. We'll take your calls or comments on all matters financial. 800-321-0710. And next hour, we'll be talking about a lot, but I really want to hear from you. So call us 800-321-0710 if you have a financial question. If you want our free 27-point ultimate financial game plan, call us now. Use all of your worry to get your financial house in order. The good of this interest rate hike is treasuries are at rates we haven't seen for years. Fixed annuities are at rates we haven't seen for years. Insurance contracts, obviously stocks, bond funds, bad. There'll be good lifetime bargains in the future. So folks, make sure you have a will. Make sure you have insurance. Make sure you have a trust, a living will, healthcare directives. There are financial planning concepts that even though we are in the middle of an economic hurricane, potentially, you want to get right. So call us for the Protection, Savings, and Growth Review, 888-988-JOSH, 888-988-5674. Up next hour, we'll be taking your calls and talking about the housing market needing a difficult correction so that folks can afford homes again. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeart Radio app. #1 for music, radio, and podcasts.
There's no one more connected on the radio. That's